What is a credit score? A credit score is a statistical model and it's a predictor of future performance based on prior experience. So it's a model based on known performance. It's a scorecard that's factoring in many characteristics, and like I said, it's a value falling in the range from approximately 300 to 850. So when it comes to credit scoring, it uses a credit data as predictive variables and it forms a model that predicts likely future credit performance. So the logic behind this is really history does repeat itself. So where does your score fall? As you can see here in the chart, there are four different levels. Level 349 to 619 is poor credit. You will likely not get any consumer loans if you are looking to apply within this category. Fair is 620 to 649. Good credit is 650 to 749. And great credit is anywhere between 750 and 849. So what are the minimum requirements to generate a FICO score? When it comes to generating a FICO score, you really don't need too much. You need at least one account that has been established for 6 months, and obviously there has to be indication that the customer is not deceased. Now, when it comes to new credit, everybody starts around the same level. You could have one account that's open for 6 months and have a 715 credit score, but us in the lending world call that an elevated score. So it doesn't actually help us determine and give us indications for your future behaviors, because if you only had one account open for 6 months, it's not going to allow us to see how your future behaviors with credit are going to be. So just because you have a 720 does not mean that you'll be approved for a loan, because like I said, we consider that an elevated score. So who records your credit data? In the credit world, there are 3 credit bureaus that both report and receive information from lenders. And those are as follows: Equifax, TransUnion, and Experian. These are the 3 credit bureaus. They're all different companies and they do report activity differently. So some bureaus will receive information from one lender, but not another. Therefore, the credit scores will vary. Even though they do report, they do not rate your credit, approve, or reject any applications. They really are only there to store and report your credit information. So how is your FICO score calculated? So when it comes to your FICO score, there are some basic principles that's going to show you how your score is calculated. And that is as follows. 10% is new credit. So any credit opened within the last 30 to 60 days affects your score 10%. Also, what types of credit are being used. So installment versus revolving, that counts for 10%. We also look at length of credit history. That accounts for 15%. Length of credit history is going to be looking at your oldest account that you have opened. So your oldest credit account is going to be how long you've had credit history. They're going to look at 30% of the amount owed. So that's going to be your limits to your balance ratios, as well as your payment history. That counts for 35%. So have you ever been late in the past? Well, that's going to affect your score drastically, which will be 35%. So one thing to note is some of these factors affect your credit score astronomically, when others account for only 10%. So it's really important to know how your score is calculated. So what is not in a credit score? FICO score considers a wide range of information on your credit report. However, there are a lot of things that they're not going to consider, and that's really important for you to understand. So what they're not going to consider is your age, your occupation or your salary, any interest rates that you pay on any various loans. They're definitely not going to discriminate based on your race, color, or religion. And they're not going to discriminate on any certain inquiries, such as consumer-initiated inquiries through things like annualcreditreport.com or Credit Karma. They're not going to know if you're participating in credit counseling. It definitely does not look at any checking and savings account information, and very important, things like cell phone bills or any other accounts that are similar are not going to show up in your credit score. So it's not going to help you out if you're looking to apply for a loan. So we have just briefly discussed what is not included on a credit report. However, it's really important for you to know what is included on your credit report. And that's as follows: your name, your address, your social security, any accounts or anything that's indicative of predicted future credit performance, such as your open and closed accounts, looking at your payment history, length they've been opened, as well as your current balances. If you have any things like collection or judgments, things that you haven't paid in the past that are now affecting your credit score because they're saying that they have gone unpaid. They're also looking at any credit inquiries within the last 30 days. They're also going to be looking at your proportion of your balance to your credit limits. So it's really important that you keep those balances low. So why didn't you get a perfect score? And why is your score so low? As you can see here, I gave you an example of what it would look like if you were to pull your credit. you're going to see your 3 different scores from your 3 different bureaus, and then there's going to be reason codes as well as an explanation of those codes underneath your score. So the reasons codes will be included in the report when a credit score is ordered. The reason codes are listed in descending order of importance and are displayed on each score. These reasons codes show which area of the consumer's credit did not score as highly as possible. So in some cases, these reasons highlight issues not associated with the traditional derogatory information. These codes can be relayed back to the borrower, and they can help explain why your score is what it is. So in this example, the scores are 486, 531, and 493. So in this case, this score is extremely low, and it gives you the reason code and then an explanation. So in this case, there's serious delinquency or collections filed. An example of that could be a medical collection or possibly a cell phone bill that went unpaid and now it's affecting the credit. It's also going to be looking at the time since the delinquency, and it's been too short to determine how safe they feel to move forward and give you a better score. It's also going to say here that the number of accounts with delinquency is extremely high, and those amounts owed on those delinquent accounts are also extremely high. So this is going to show you a good example about why your score is potentially so low. So sticking on the same topic, now we're going to move forward to how long do items remain on your credit report. If you have derogatory information on your credit report, how long do they stay on there and affect you? It really depends. There is a 7-year rule where most items stay on for at least 7 years. But depending on the severity as well as the type of judgment or derogatory information, it may show up longer. So in this example, such as bankruptcy, Chapter 7 or 11, it's actually going to stay on there for 10 years from the date that you filed. Anything like suits or judgments against you can stay 7 years from the date of entry. Now, when it comes to tax liens, it is very different. If you have a tax lien that's paid, it is only going to stay on there for 7 years from the date of payment. But if it's unpaid, there's no limit. So you definitely don't want that showing up in your credit report. Anything like criminal records or charge losses, charge to profit and loss is also going to be 7 years. So just remember the 7-year rule. So there's going to be 2 different types of credit that's going to be reported on your credit report, and that is revolving and installment loans. And they're both very different. So revolving lines are things such as credit cards, home equity lines of credit, and any accounts that are used that are paid off but never closed unless it's requested by the borrower. So kind of think of it as a revolving door. You use it, pay it back, but it keeps going until you, the borrower, decide to close it. An installment loan is different. It's set for an incremental amount of time, anywhere between 24 to 72 months. There's a fixed payment, and once that account is paid off, it is closed in full. So both affect your credit very differently. So we've talked about credit a lot today, but most importantly, what can we do to improve our credit? There are a lot of different things to do, and there are a lot of ways that you can improve your credit. One way is to keep your balances low. The creditor is going to be looking at your limit to your balance ratios, and you want to make sure that you keep those limits below 35%. You don't want to apply for too many loans within a consolidated period of time, especially if they're different: car loans, credit cards, mortgages. If you're shopping and it's the same category, it won't affect you as drastically as applying for a lot of different types of credit. Also, you do not want to close any old revolving lines, because we're going to be looking, like I said, at the length of credit history. So say you opened a credit card 10 years ago, your next one wasn't 5 years later. If you close an account that's 10 years old, it's going to drastically affect your credit, because now it's saying that your credit's only 5 years old instead of 10. You also want to have a minimum of 3 revolving and at least 1 installment loan. You also want to make sure that you keep your inquiries to a minimum. Like I was saying, it's the same thing with applying for loans. If it's the same category, such as you're rate shopping for a mortgage or an auto loan, that's different. They're going to look at that pull very differently. However, if it's different topics, you want to keep those to a minimum. Also, do not miss any payments. Anything 30 days or over is going to hit your credit drastically by anywhere between 20 to 35 points. All right, guys, thanks so much for stopping by, and I hope this credit basics tutorial helped you guys out a little bit with improving your credit needs. Once again, my name is Melissa Brodak with the Home Buyers Hub, and stick around. We're going to be talking next about the mortgage process and how credit affects your mortgage. So if you guys have any questions, please leave them in the comments box below and subscribe for more videos. Thank you, guys. Have a great day.